Is lump sum investing better than dollar cost averaging? Should we invest all of our money at once, or should we do it over a certain time frame? That is what we are talking about in today's video. I am Tiffany Thomas, a financially free millionaire. If you're looking to become one of those, make sure and hit that like button and hit the subscribe button, and we're going to dive right in. Let's say your emergency fund is already funded and you've paid off your high interest debt, and you've come into a lump sum of money. Maybe you received an inheritance, or you sold your home and you have a lot of cash from that, or maybe you got a bonus at work, or your business did really well one month, so you have this large amount to invest. Now, should you invest it all at once? That would be a lump sum investment, or should you dollar cost average? And by dollar cost averaging, I am talking about investing a certain amount for a specific time frame, no matter the price of the investment. So if the price of your investment was to drop one month, you would still invest. If it was to go up the next month, you still invest. If it was to go up even further the next month, you still invest. And then if it was to come back down, you still invest. It is averaging out that cost because you are continuing to invest over a specific time frame. To give you a specific example, let's say you have $12,000 sitting in your savings account. You would invest $1,000 every single month for a full year. That would be dollar cost averaging. And then on the flip side, lump sum investing would be taking that $12,000 sitting in your savings account and immediately putting all $12,000 into the stock market, into an investment. Which one is better? A lot of people would actually say to dollar cost average, to hold on to that full $12,000 and slowly invest it over the time frame. But studies show the opposite is true. You would actually make more money by doing a lump sum investment rather than dollar cost averaging. So they are saying that you need to get your money invested as quickly as possible because you will make more money over the long term. And the stats on this are about 71% of the time you will make more money by doing a lump sum investment than doing dollar cost averaging. We are going to look at a few examples and see exactly how much more you would make if you were to do a lump sum investment. But if you are thinking, oh, I don't even know what to invest in, I just did a training recently in my Facebook group, Investors to Seven Figures. So I will leave a link below to that group. You can join the Facebook group and watch the training to get started investing in the stock market. Okay, let's take a look at a few different examples. Okay, so let's say we have $12,000 to invest, and we're going to leave this at months to dollar cost average at 12. And then the total years we are going to invest, let's say we'll do 20 years. And then we can hit analyze. And we can see that the lump sum wins. You can see that it is at 71% of the time versus the dollar cost averaging way is 29% of the time. And then you can see our average performance was 84,407. And if you look over to the dollar cost average side, you could see that it's only $80,948. So a difference of about $4,000. Now, let's say we have an even larger amount. Maybe we received a really nice inheritance of $100,000, and we're going to invest that over a period of 20 years still. So if we click on Analyze, our average performance for the lump sum is $703,392, and then for dollar cost averaging, it is $674,563. So around 30 grand. And you may think that sounds like a lot or not a lot, but that is almost one person's salary in a year. So to me, 30 grand is quite a bit of money. And let's look at one more example. Let's say you sold a house and it was all paid off. So you have $500,000 to invest. And this time we are going to do it at 25 years. So if we hit analyze, the lump sum still wins, and our average performance is $5,670,404. And then if we come over here to the dollar cost average performance, we can see that it's $5,456,200. So once again, quite a bit of money that we are missing out on if we are dollar cost averaging. So we can see that by doing a lump sum investment, it really does outperform the dollar cost averaging. So if we are looking just strictly at numbers, we would always want to do a lump sum investment rather than try to dollar cost average that money. But personal finance is not just about the numbers. It's about ourselves as well. If we are going to lose a lot of sleep at night, if we invest a lump sum of $500,000 and then the very next day the market goes down and we watch that $500,000 drop, and then it goes down even further the next day and it drops again, and we get so nervous that we sell our investment and lose out on that money that we could have made if we would have just let it stay in the stock market and let it come back up over time. So if we are going to become really fearful and sell that investment if we start to see it drop, then we definitely don't want that to happen. So we may not be able to stomach investing a really large lump sum. We want to be able to sleep at night. But I wanted you to see that you can make more money by doing a lump sum investment versus dollar cost averaging. And maybe if you're not looking at a $500,000 lump sum investment and it is more around 10 grand, maybe that is something that you can stomach if you see it start to go down after you invested the money. But it wouldn't be by hundreds of thousands of dollars. Perhaps you would be more okay with that and you would not lose sleep at night. As you can see, it is better to do a lump sum investment rather than dollar cost averaging. Comment below and tell me if you are going to do a lump sum investment or if you will still dollar cost average. I am curious to know. And if you aren't able to stomach the lump sum investment, realize that you can still invest that money over time. You can still dollar cost average and make really good returns. It is going to be better than leaving your money sitting in a savings account, earning hardly any interest at all. We don't want to just keep all of our money in a savings account because that is not safe, because it is not even keeping up with inflation. We want to make sure and invest our money, whether that is doing a lump sum investment if we can stomach that, or dollar cost averaging, investing our money over time, whether the market is going up or down. It is more about time in the market rather than timing the market. If you found this video helpful, please hit that like button and share it with someone else who would like to hear this information, and hit the subscribe button to subscribe to my YouTube channel, and hit the little bell to get notified on when I post new videos. And if you want to see even more content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.